Good morning. It is Tuesday, September 16th. I am Zach Howard, and this is my morning market update. We are on the eve of Central Bank Parade Central here with the Fed on tap and the Bank of Canada, my home country's favorite monetary policy easing. Both going to announce cuts tomorrow to their prime lending rate. More importantly, guidance on where they see policy going forward in the next 3 to 4 months. But do we even need to look at what these talking heads in the suits are going to say at the news conference with the media flashing the lights and all the BS that is that, when you can just look through the lens of the bond market, and the bond market really tells us the story, not the guy with a suit on TV. Took me a lot of time to figure that out, working at a bank. We used to sell money for a living. I used to ask, well, how do we talk about interest rates? And the management team said, well, we don't want to talk about that. It's like, how do we not want to talk about the product we're selling? Because they didn't understand. Like a lot of people in the world, that's what keeps the game going, which is so ironic. But let's look inside the lanes of the Canadian economy. Really, what we're in Canada is a country built on real estate and a country built on government services. Most of the people in the country of Canada, they depend on the government, whether federally or provincially, for some kind of source of fiat money, whether that is a check for work at one of those establishments for whatever they want to call, or it is come a socialist program. We are a country so rich in natural resources, but we have not been able to embrace what Mother Nature has blessed us with, particularly oil and gas. Eventually, that will become the case. I hope so. That is my confidence as someone born and raised here with my kids who are also Canadian. But I had grandparents go to Venezuela in the 80s, and they told me a total different story of what it ended up evolving to in the early 2000s. So I pray we are not on the verge of something like that, but something needs to change quickly. As we look at this chart here, just the guidance of policy, where it's gone over the last 5 to 10 years, we have not been able to tap in what we already are gifted to have, particularly on the natural resource sector, but even on the technology side. Most of our tech entrepreneurs, the superstars, started out in Toronto, started out in Vancouver, and they head to Silicon Valley. They head to East Asia. They head to places where they're respected for the gifts they have. If you're looking for politicians to turn this around, I don't care if you're on the left or right side, it ain't going to happen. It's going to have to come through the free market. It's going to have to come through signal, which is capitalism. Further to the Bank of Canada, it is on deck, like I say, tomorrow. They have all the actual Keynesian macro data that they rely on to say where you're going to cut. They're going to cut 25 basis points tomorrow. I'd be very surprised if they do 50. They're going to do 25 at the next meeting and 25 basis points after that. Why are they going to do it? The bond market already says they're going to do it. Just look at the chart here. The Canadian 5-year yield, that's the chart we're paying attention to when we're looking at the Bank of Canada more than we're looking at the short duration rates like you would otherwise in the Fed. Why is that? Because in Canada, back to what I said the economy is, it's the real estate market, particularly the residential side. Toronto and BC, that's what get the votes. That's what really impact policy and where policy decisions are. We have a massive wall of mortgage renewals ahead of us here for the rest of 2025 and even more larger into 2026, which I'm going to show you in the next slide. The banks, the 5 to 6 big banks, they run Canada. 5 to 6 big families, they run Canada. They are going to influence the politicians. The politicians are going to influence the Bank of Canada, the central bank. They're all connected at the hip, but the bond market already knows this. Long-term chart of the Canadian 5-year yield, which drives mortgage rates. It's at key support level here, 250, 260. It breaks this. The long-term trend is back intact. Further debasement of the currency. The currency is always the relief valve for poor policy decision. The question is not if we go back into the low twos or even below that. The question is when. And it's not just the Canadians residential, the big banks who are all relying on lower cost of servicing that big massive wall of debt. It's also the governments themselves. The federal government and the provincial governments all borrow money constantly. They never repay the money in principle. They just keep servicing the interest. And the only way that game keeps going is that the interest servicing costs can stay low. That is why central banks and governments are all connected at the hip, which leads to inflation, which leads to debasement, which leads to loss of purchasing power of the fiat currencies. Whether you're Canada, the UK, Japan, US, it's all the same thing, just some are faster than others. Some great charts here from Danny. Looking at real world inflation, if we actually use the methodology we measured back 40 years ago, it'd be a totally different story. 26.5% almost since 2020. Annualized, you're looking at around 5.3, 5.4% every year for the last 5 years. What do we know about the rule of 72? Albert Einstein. Compounding. 13.6 years at this rate of annualized inflation, you lose 50% of your purchasing power. So we project out 13 years time, you make $100,000 a year, really in real terms, that fiat is only worth $50,000. That's what I talk about, looking at the price of things, particularly hard assets, through the lens of gold, through the lens of Bitcoin, stuff that cannot be debased with policy from central planners, people in suits on TV. Back to that, get the game down for what we're playing here, guys. This is really the end game, is how much they can make the currency devalue in real purchasing power, which helps the government finance the deficits, capital gains tax, etc. What we're looking at here, we got the Fed about to cut rates into the stock market in the US at an all-time high. 666 to 6666 in a 16-year time span. Truly astronomical, but when you look at it, it's really through the lens of that denominator, that falling currency, and how you measure money. If you look at the lens of the S&P, measured in gold ounces, it really hasn't gone anywhere. It's actually gone down. But what can we expect if the Fed is going to cut rates here tomorrow? 25, possibly 50 basis points. 3 months later, the average returns are pretty significantly. But then if you look out a year out, all I see is green. Could it be different this time? Absolutely. But remember the rules of the game, which I just said previously on the previous slides. They got to keep this fiat Ponzi going. My favorite movie from finance, the favorite scene of it, I watch it once a month to keep all this in context, and I'm not crazy about it. It's just money. It's made up. And when you get that really through your head, a lot of this craziness really doesn't matter. Have fun out there. Be safe, and good luck.